everyone. Let everyone get settled. I'm Scott-Dawkins. I lead our forecasting and business intelligence team at GroupM. The biggest output of that is our this year, next year forecast, which we put out twice a year in December and June. So the next one's coming out shortly. That's why I've been up at all hours of the day and night listening to earnings calls and looking at market data. But I'm going to share some of these, previous results with you and talk a little bit about what we're seeing in the economy and talking to advertisers and ad sellers, what we expect over the next 1 to 5 years. So first, the big numbers. This year, 2024, we are forecasting 5.3% growth in total advertising revenue, up to $935.9 billion. And then it continues to grow. That's actually better in real terms than last year, even though the nominal number is smaller, because inflation continues to come down around the world for the most part. A little bit of a hiccup here in the US, if any of you have been following the trades. The Fed is meeting today. But for the most part, we're seeing that gradual trend down of inflation. So better growth in real terms this year. And then we expect the next 5 years to show a 5.6% compound annual growth rate through 2028, 2029. For out of home, that's going to look like 8.3% globally this year to $37.3 billion. Now, over a longer time horizon, we'll look at this chart, and you can see, for the most part, again, we're looking at now total advertising revenue. We'll get into some more specifics on out-of-home in a few slides, but at a total industry level, it looks about like this. Now, the blue line is going to be advertising growth. The gray line here is nominal GDP growth at a global level. And you can see, for the most part, historically, since 2000, advertising growth has actually lagged GDP growth. It's been a little bit slower on the whole. That reversed course in the late 2010s. You can see there the blue line overtook a huge disparity in 2021. I think everyone had a pretty good year. I doubt I'll see another year of total global advertising growth greater than 20%. But it was fun to work in this while that was happening. It was like, are these the right numbers? Could we get markets to actually realize that, yes, companies like Google and Meta were growing 30-40% year on year. But then we've seen that now kind of return to the previous trend with GDP growth over advertising growth. And we expect that to continue over the next 5 years or so. There are several reasons for that. I'll go into a couple here. I think one of those is what I mentioned already, interest rates. That had a big impact in terms of some of the really high intensity advertisers that were driving that advertising growth in the back half of the 2010s. We look at D2C companies. Therabody was just up here. There were a ton of these venture funded early IPO companies that were in an era of basically free capital. Very, very low interest rates, very easy to get new capital, and they were plugging a lot of that straight into advertising and marketing. They were using that to grow users, to grow revenue, and they were being rewarded for it in terms of investors and in terms of valuations. And so that helped drive up that advertising growth in the back half of the 2010s. Now, we are no longer in a zero interest rate environment, as anyone who has maybe thought about buying a house or a car can tell you. It's a very different scenario right now. And as we said in December, I think somewhat presciently now, interest rates will stay higher for longer, especially in the US. And that is bearing out. We said it in December. We were not projecting the kind of 6 interest rate cuts in the year that others were. Now we're looking at maybe 0. Those are going to take a little bit longer to come down, and until they do, we expect continued more conservatism from brands and advertisers in terms of spending at that kind of intensity on advertising and revenue again, and also the kinds of IPOs that we had been seeing over the past several years as well. It's a much quieter environment now. Now, another big trend driving that blue line up, and then I'll move on as well. We've got a lot of context for this slide to get through. overall trends towards globalization consolidation, and a lot of that happening across the largest digital platforms, Google, Meta, using AI, using this self-service platform for these small and medium-sized businesses, which make up a majority of their revenue base, to make it so easy for those small and medium advertisers to come in and advertise on the platform. And so part of this is also a shift from potentially unmeasured media or media moving off of print into digital, the growth that that platform afforded during those times. And also they made it easy for Chinese sellers, advertising sellers abroad, to use these platforms to reach international customers. And that's a big trend that we've seen over the last decade and are continuing to see now with folks like Temu advertising or Temu advertising on Pinterest and Meta. TikTok used this same exact method when they were trying to grow in the United States. And we see it on platforms like Amazon and Walmart as well, the direct manufacturers, not just the retailers, but the manufacturers advertising on these platforms as well. Now we are expecting that to continue, but not necessarily at the same growth rates that we saw last year and in years prior. So all of this is leading into that expectation that we will see more consistent growth over the next 5 years and returning to a trend of slightly lower than GDP growth. Now, I've mentioned a few of these things. I won't go into a huge amount of detail, but these are some of the drivers that we are looking at on a day-to-day basis to help us gauge what we should be expecting from the advertising industry going forward. So unemployment rate, that's a positive. Especially in the US, it remains at near historically low levels. And that has definitely, in my belief, been helping consumer sentiment in the US, keeping up US retail sales, which have remained really pretty strong this year, especially given interest rates and the continued rate of inflation. So all pointing to continued relatively strong growth in the US. New business creation remains at very elevated levels versus pre-pandemic. Now, that's actually been ticking down over the last couple of months, but in general denotes good competitiveness since businesses are ultimately the ones who are spending on advertising. New growth in small businesses, new competition amongst businesses is generally, again, a good sign for where we see the market heading. I mentioned US retail sales. China retail sales tends to have an inverse correlation. So I mentioned on the previous slide when we see things like Chinese manufacturers advertising on those marketplaces, the slowness and the sluggishness of the Chinese consumer is actually helping drive those advertisers into looking for growth in the US and other international markets. So slowing domestic demand in China can actually lead to increased growth from those players in the US, leading to increased competition, increased clutter, all of that as well. So it's not just looking at the US market to understand what's going to happen with the US market. Because there is so much globalization, because all these platforms are global, because commerce is global, we are really looking at how all of these markets interact as well. Now, we're drilling into out-of-home specifically. So these are top 5 markets on the left for 2024. There's a lot going on this graph, sorry, but there's so much fun stuff to talk about. So expectations for out-of-home growth 2024, you can see the US still the number 1 in 24. That actually flips in 2025, so I'll explain the slope graph. You're looking at total advertising on the far left, so that country's rank in terms of all advertising, total advertising industry. Then their rank for just out-of-home in the middle, and their rank for just digital out-of-home on the far right end of the slope. So US still number 1 in 2024. Losing that spot back to China in 2025. It had been the number 1 up until the pandemic, taking longer to recover than the US. And you can see there that recovery growth rate as well, right? 18.3% growth in China for this year. And then Japan, Brazil, and France. But there are some fun things when you start to really peel apart rankings, I think, especially from digital and non-digital. So you have a few markets where they have a higher total rank than they do out of home. You have like India, for example, and especially digital out of home for India in there, not technology not quite as far along or not as urban as places like the US. And then you have some like Mexico, only ranked 15th if we're looking at total advertising industry, but up to 10 in digital out of home. South Africa, digital out of home drops down. I don't know how many people are familiar. There have been long-standing issues with power outages there, and so of course, digital advertising inventory being impacted by load shedding and the delivery issues with power outages across the country. So really interesting things to pick apart here. What else? Kenya, interestingly, I left that one on here. Flew into Detroit last year and was looking at all the billboards on the drive from the airport into the city, and it was basically cannabis and betting and cannabis and betting and cannabis and betting, which is, I think, not uncommon, and was not uncommon in some place like Kenya as well. They actually banned digital billboards for sports gambling because it became such an issue there for youth and also just for economics in that country. And so we do always have to be very aware of the regulatory drivers as well within total advertising and within out of home specifically. I was also talking with someone earlier this morning about France and some of the pushback there in terms of light pollution, energy for digital out of home. So it remains a very dynamic channel and something that we watch very, very closely across general trends and then also political and regulatory as well. Stepping back up to global and total, you can now see how out of home fits into the total share of all advertising. Everything in this blue box is our pure play digital. So that includes search, it includes retail, and then other digital, which is social video, everything else that doesn't fit into either search or retail. And then we have the traditional and digital extensions of the other channels together. So the big blue box is all of TV. That includes linear and CTV. These are the ways that I'll refer to them throughout the rest of the presentation. Out of home includes both static and digital out of home and so on. And you can see there in terms of just about the third largest box in our tree diagram for out of home total. Now those shares, that was a static picture, just 2024. If we look at over time, I just did this chart in preparation for being here with all of you today, looking at US channel share shift over the last 10 years. So what has happened from 2014 to 2024 in terms of channel share? Most of this will be unsurprising. Linear TV used to be above 30%, now just above 10%. That share has been taken over by digital, so you can see the growth, obviously, of retail, search, and other digital on the right-hand side. So 2024 in the light blue bars, growing share on that side. What I found interesting, as I was doing this and preparing, was really the extent to which, like other traditional channels, out of home has lost share in the uptake of digital. But unlike digital audio and CTV, which have really grown share alongside the digital pure play channels, digital out of home hasn't yet managed to capture that same kind of growth. So I think, in agreement with a lot of what was said by the panel and by Anna as well, certainly opportunity to, to continue to grow the story for out of home, and especially for digital out of home in the US and globally as well. So let's talk a little bit about some of these other channels, just to paint a fuller picture. So digital globally, we are expecting to finish the year up in 2024 by 7.3%. That was our December number. I am expecting, probably after earnings from Q4 of last year and Q1 of this year, that we are likely going to revise that number upward. And then the stat here, by 2028, digital will be larger than the entire advertising industry was just 2 years ago in 2022. That's how much it's growing, how much it's taking over the total share of the pie. But it's not necessarily even. So this gets a lot of raised eyebrows from clients when I present it. If we look at total advertising revenue, and we take the revenue from just the top 5 sellers, so Google, Meta, Amazon, Alibaba, and ByteDance, including TikTok, those players grew 23% on a compound annual basis from 2016 to 2023. If we then pull out all of their revenue, remove it, the rest of the industry grew less than 1% on a compound annual basis over the same 7-year period. Which makes us start to feel like a very zero-sum game. Now, that's not to say they weren't fast-growing players within that. I think Walmart is one story there, right, where they're now at $3.5 billion in advertising revenue in the financial year 2023. If we add Vizio to that, that puts them up at about $4 billion. So just into our top 25 media sellers ranking. But that's also been next to the decline of other traditional players, right? So kind of a stark comparison there. So let's talk about some of the players that may be in that rest of the industry box in television. By 2028, we expect linear TV to fall to its lowest level since 2004. But that's not necessarily the same pattern that we're seeing in CTV. As I said, that share has been growing. We're expecting CTV to grow globally by 13.8% in 2024. Now, talked a lot about, or I've heard this morning already, a lot about reach and awareness and impact and what that can do, and I absolutely agree. There is going to be a need for advertisers to have ways and means to reach audiences, to impact them in ways that has been vanishing on linear TV for some time. So let me explain this a little bit. Again, a lot going on. I like my graphs and my numbers. So what we're looking at in the graph is video revenue, not just advertising, total video revenue. So the linear revenue in the dark blue includes things like affiliate revenue, the light and advertising revenue. The light blue, which is streaming, includes not just CTV advertising revenue, but also subscription revenue from CTV players. And what we're looking at is the dramatic shift from, in Q1 of 21, 80% of the legacy players, 80% of their revenue was linear only. Just 2 years later, 3 years later, at the end of 2023, that figure was 70%. So as consumption has shifted onto CTV, so too has the media owner focus there. And consumption is shifting. We've done some internal modeling using Nielsen data. We're expecting that time spent with CTV will overtake time spent with live and time-shifted TV by 2026. So we are very close to reaching that. The right side of the chart shows the same revenue split if we include Netflix. So it just takes the numbers down because we're now including Netflix in the streaming numbers. So what happens there if we think about the total time spent with CTV making up the majority of time that people spend on total TV? Well, by 2027, that results in a significant decrease in the average ad hours per week that people see. If we assume that just 30% of all CTV viewing time is ad-free, yes, they've been adding ad-supported tiers. Yes, lots of people who initially sign up for these services are choosing ad-supported tiers, but there are still a significant number of folks who pay to avoid ads on all of these platforms as well. So if we assume just 30% is ad-free, and we're assuming again that CTV is overtaking linear by 2026, then the average advertising hours for US audiences will fall by 17% by 2027. And that's where advertisers are now looking at where they can, what's going to happen with this inventory, what are they going to do, where are they going to find those opportunities for brand growth and interest and impact and awareness that they used to get on linear TV. So out of home, one quick graph here. This will be hopefully not too much news to most of you in this room. But future growth within the US out-of-home market being driven really primarily by digital out-of-home, in our opinion. And for the 4-year period from now to 2028, looking at a compound annual growth rate of 4.2%. So, above inflation. Obviously, we'll be looking again at all of these numbers over the course of this month and releasing a new report towards the beginning of June. So keep an eye out for that. Now, one of the other things that we did, and I was, again, really interested listening to the panel just before me, CMOs from these various industries, we took a look at the contribution by industry in our December report, really to better understand, the different makeups and, how they thought about advertising, what the typical advertising as a percent of revenue was for these various categories, and their contribution to total industry and total industry growth. So this, again, should not surprise you, but the largest category for total advertising, CPG at 19.7% by our estimates. Historically, not a big, spender on out of home, although I will note, and I think, unsurprisingly connected again with the timeline of linear TV, that we have heard more mentions both on the advertiser side and on the out-of-home media owner side about CPG being a larger growth category, right, in terms of looking for those opportunities for awareness and reach in mass media. The second largest group here being digital endemics, which is maybe not a category that most of you are familiar with. It's one that we use internally at GroupM very, very frequently. It would include a lot of those D2C companies like a Therabody, even though they have retail outlets now. They likely started 100% online. Again, maybe they grew up in that period of very low interest rates and they were spending high percentages of revenue on advertising and growth. And so we group them together. We think they behave more like each other than they do others in their traditional categories. So Meta, Amazon, and Google are in our digital endemics category rather than in the media and retail categories. You'll see more on that on the next slide. And then we have retailers, media, entertainment, technology, financial services, and so on. That chart looks a little bit different if we now organize it by advertising as a percent of revenue. So here, digital endemics jumps up to the top in a very, very big way. They remain the highest intensity advertisers in our analysis, with a median of 12.6% of revenue spent on advertising. And I think a good opportunity for out-of-home in this space as they look to transition from those very lower funnel D2C direct response metrics and advertising allocations into more brand awareness and growing the top of their funnel as well. Luxury, very stalwart supporter of out-of-home, obviously. They are actually the next up in terms of advertising as a percent of revenue. And then you get into media, entertainment, CPG, pharma, down at the bottom below 2%, telecom, technology, retailers, and auto. We do expect continued growth this year from CPG, luxury, and increasingly technology as we come out of that sort of COVID hangover period where everyone went out and bought their laptops, TVs, everything for their home at the start of the lockdown. We're now coming up on 3 years out, so the start of that typical upgrade cycle. And so we are expecting a return to growth there in addition to CPG. Again, I think great opportunity for out-of-home where they've been really rewarded for investing in advertising even against the backdrop of continued high inflation and input cost inflation. They have really doubled down on the ability for advertising to grow top and bottom line. So we expect to see continued growth from that category this year as well. And that's it. I think I made it all the way through. I'll get you out for your break and your coffee. Thank you.